All right. Hello,
Okay,
everyone.
go ahead.
You good? Okay. Hello,
Yeah.
everyone. Thank you for joining us today for our webinar, Florida Insurance Rate Hikes, Creative Solutions on How to Budget for the Increase. My name is Jamie Still, and I'm the current chair for the Associate Members and Events Committee, and I'd like to welcome everyone on behalf of the DSCA. I will now turn it over to our moderator for today's webinar, Platinum Associate Member Shauna Fleischbein of Castle Group.
Thank you, Jamie, and the DSCA board for hosting this presentation. And thank you, everyone, for joining us this afternoon. My name is Shauna Fleischbein. I'm the Business Development Manager for Castle Group Property Management, and I'll be moderating our discussion today on drastic insurance rate hikes in Florida with creative solutions on how to budget for the increases. So we have a lot to talk about, but before we get started, let's go over some Zoom protocols. And let me get my screen shared here again. Give me a second. All right. So we want to make sure that you mute your audio and video and keep it muted unless you're called upon to speak. Please use the chat room function during the program to pose your questions. Try to keep the questions as general as possible. And if there's time at the end of the program, we'll take some additional questions then as well. And then stay on through the extent of the program to learn more about the DSCA Platinum Associate Members Prize giveaways. So now I want to welcome our panelists and have them introduce themselves. So we'll start with Stephen Fisher of CBiz Insurance.
All right, hi everyone. Look at that, I figured out how to unmute my microphone. I'm Steve Fisher, I'm Vice President of Insurance in the Community Association side with CBiz Insurance. We do have one of our locations based over in downtown Sarasota. I've been in the community association space for over 5 years, and I am also a chartered property and casualty underwriter.
All right, great. And now we have Sally Voorhees of McGriff Insurance.
Hi, everyone. Sally Voorhees with McGriff Insurance. McGriff is owned by Truist Insurance Holdings, which was BB&T and SunTrust just merged to form Truist. McGriff is the 6th largest insurance broker in the United States. Personally, I have been doing community association insurance for the last 14 years in Florida.
And then last but not least, with our insurance side, we have Joe Thompson of Gulf Shore Insurance.
Thanks, Shauna. Joe Thompson, Gulf Shore Insurance, Acrisure. I've been with Gulf Shore for about 9 years. I'm a partner and client advisor specializing in mostly coastal condominium associations, Barrier Island and other island areas along the west coast of Florida is essentially what my specialization is, and happy to be part of this today. Look forward to the discussion.
Right. And then we also have with us Donna McComb of Cadence Bank and Pete Rossi of Forge Engineering to discuss the creative financing solutions. So I'll let them introduce themselves quickly.
Hi, I'm Donna McComb. I am an association service account manager and the community association loan specialist at Cadence Bank. I've been with Cadence for about 4 years, but I have 20+ years of lending background in association services, and I'm glad to be a part of the panel today. Thanks for inviting me.
Hi, everybody. I'm Pete Rossi. I'm Director of Marketing for Forge Engineering. I have 9 years with Forge Engineering, counseling the various communities in Florida, and look forward to your questions about engineering and reserve studies. Have a good meeting.
Right. Well, we have a lot to get through here, so let's go ahead and get started. So several Florida insurers filed for premium hikes ranging from 15 to 31% last summer. Some have reported increases of upwards of 100%. Today, we're going to talk about what causes these huge increases, as well as some creative things we can do in our reserves and budgets in order to maintain financial stability at our associations. A number of trends within the property insurance market, including increased costs for reinsurance, is at the forefront of the issues that have caused the rate hikes. So we'll start with Sally. Can you tell us specifically how the reinsurance issue brought us to this point?
Sure. So reinsurance is actually insurance that carriers purchase for themselves. And they renegotiate those reinsurance treaties every year. Reinsurance is a global marketplace. So while the slide talks about the financial crisis really reinsurance helps them to bolster their surpluses. So carriers can take greater risks or maybe take more risk in a specific geographic area when they have more reinsurance. With the financial crisis on the slide, they talk about the funds kind of becoming restricted. So what that really, the result there is that, you know, the surpluses didn't look as good. So carriers not only have to go out into the marketplace and buy more reinsurance, but reinsurance itself has become more costly because it is a global marketplace. So when billions of dollars in claims get paid out in, say, wildfires over in California, or floods or earthquakes, it all affects that reinsurance marketplace. So that pushes pricing up, and recoup their profits, that they push the price up for our carriers, and our carriers translate that into premium increases.
Okay, perfect. So when you talk to people about the number of storms we've had in recent years, other than Irma, the reaction seems that we really haven't had, you know, enough storms to cause all these enormous hikes. So Joe, can you tell us how storms can affect the increases?
Yeah, I mean, the storms are one variable in a very cumulative issue, right? So when you think of weather events, we've got to consider what is the market environment that we're in right now. It's essentially what everybody has heard. It's a hard market for property rates, right? For coastal condominiums, and frankly, even single family home, you know, homeowners insurance is affected as well. And if you go back, you know, in the short history here with hurricanes, and you look at the year of 2004, 2005, where in 2004 we had the Charlie, Francis, Ivan, Jean, the 4 storms in a row that all hit Florida. 2005 we had Wilma. So those were significant events, significant, you know, very active storm seasons. But then we had a 12-year gap of no storms whatsoever from 2005 to 2017. There was nothing that hit Florida. So of course, for those ensuing years, we had a soft market where you know, a number of terms and conditions and premiums would decrease. And that was about 2013 where that happened. But prior to that, we were in another hard market. So it's a very cyclical market. So now we're back in that same exact cycle after Irma, which was sort of the genesis of a lot of this for Florida. But it's not just about storms. We know with 2017 was significant with Irma, Harvey, other major storms. And we know last year, 2020, was a historic year with an unprecedented number of storms with regard to, we ran out of names. We went into the Greek alphabet. So it's one of those things where we're in this unprecedented time, a very hard market, but it is cyclical. We've seen this before, but we are in the midst of a very difficult time right now. But it's not just related to storms in Florida, because the property market it's global. Sally had mentioned, you know, wildfires, and I think when you look at a recent graphic done by the National Oceanic and Atmospheric Administration, they did a very simple graphic. They showed a map of the United States. They showed you the wildfires in California and Colorado. They showed you the derechos that occurred in the Midwest, which are very high wind phenomenons that occur in areas that are not prone to that type of an event. They showed you the winter storm in Texas, and they showed you all of the named storms that have hit the United States over the past few years. And it's staggering when you look at the number of insurable losses and the billions associated with that. And that's not even including the civil unrest that happened, all that senseless violence where billions in property damage occurred, social inflation, the pandemic, all of it is culminating. And, you know, the named storms are a part of it. And I think we'll get into some of the other variables and the other factors. I know Steve will jump into some of that. But this is just one piece to the puzzle. And in Florida, this is a micro niche market for us with condominiums.
Okay, great. So speaking
I'm sending out another link right now. I don't quite sure why the original, I think it required registration, but I'm going to send out another link right now.
Okay. So in a nauseating,
right. There was some confusion in how that was being registered with our multiple setups here. So I'm sending out a new one right now. Thank you. I hope that this will get you.
All right. So in a nauseating example from South Florida, shocker, a roofing contractor distributed flyers promising a $500 American Express gift card just for letting someone on the roof. In a similar flyer, the contractor says they're 99% sure the roof has hurricane damage. These were going out in the days leading up to the Hurricane Irma claim filing deadline. So Steve, we all heard about the lawsuits stemming from water damage unrelated to storms. How have these lawsuits played a part in the rate hikes?
Right, so thank you. This is a great point, and I want to take a quick step back to the two topics that Sally and Joe had mentioned. And the reinsurance side and the global catastrophic events are all part of the macro environment for how underwriting in general is viewed in a different kind of rate pressure across the globe, right? But the question always comes back, why is Florida so bad? Well, Joe mentioned a few things, right? We talked about us being in coastal areas, a different kind of risk. Florida has, God, how do I put this? Our legislators up in Tallahassee have the best intentions, right? And a little while back, we changed some of the state statutes, one in particular, the one-way attorney fee statute, right? Which was intended to create an environment that would better protect the consumer, those who purchase the insurance, right? But what it really did was create a litigious environment in the state of Florida that has exacerbated expenses on the insurance part, right? So the one-way attorney fee statute, it's a loser pays system that really only works in one direction, from the insurer to the insured. If the insurer succeeds in a lawsuit, a litigation event, they do not get any of their attorney fees reimbursed. It only works in the event if you're an insured and consumer and you go ahead and try to litigate one of your claims and you win, the insurance company has to bear the burden of your attorney fees, right? And we also have a circumstance in Florida where you can have fee multipliers. So attorneys can charge exorbitant fees in order to represent you. I know you'll see on the slide that the CEO of Citizens had mentioned in some portions of the state, we're seeing around 500% increases in litigation. A general rule across Florida has been at least minimum 50% of all property claims are now getting litigated. What does that mean for us? Why is this so bad? Well, about 60% of all of these litigations are for non-catastrophic events, namely, as you mentioned, the water damages and some non-catastrophic roof events. We've created an environment since 2013 where over $12 billion of legal and attorney fees have been added on to the costs that are bared by the insurance companies. And let's all be honest, we have to understand that insurance companies exist to make a profit at the end of the day. And what's happened, at least since 2019, we've seen between about $2 to $3 billion worth of expenses from the attorney fees and litigation being passed on to premiums that we all have to pay for. So, realistically speaking, we tried to create an environment that would protect consumers and us, the purchasers of insurance, to allow, to make sure there's no real bad faith claim scenarios in the insurance. But really what we've done is we've magnified the cost of all the claims being litigated.
I did, Mike A.
Can everybody mute themselves, please, if you're not already muted?
So again, really what we've done is we've created an environment that actually hurts the consumer and the purchaser of insurance. And again, Tallahassee has their best intent, but in my opinion, we've created a transfer of wealth to the tune of about $2 to $3 billion from the purchasers of insurance, and not passing it on to the insurance companies and profit, but passing it on to attorneys that are getting involved.
Okay, great. Thanks, Steve. So hold on, let's get on to our next slide here. So earlier this year, the state's property insurance industry was plagued by a rating crisis as nearly 20 Florida insurers were threatened with decreases in their financial health ratings. Several of these companies shed policies or merged with other more stable firms. Sally, can you tell us about the financial health of Florida insurance companies today, and will there now be fewer carriers to choose from?
Sure. So, the short answer is yes, there will be fewer insurance carriers to choose from. The mergers and rate increases have been attempts to stabilize the Florida insurance marketplace. However, it seems that we're hearing each week, new news. For instance, this last week, American Platinum has announced that they'll no longer write new policies. They'll renew what's there, what they have on their books, but they're not taking any new risk on. Also, the Demotech and AM Best are taking a hard look at the balance sheets of these carriers. And the other, NSM, they're also carriers are looking at their own balance sheets, and they're making decisions like leaving Florida. For instance, Everest admitted, who was a big player in the South Florida commercial condo marketplace, has just announced that they're leaving the Florida condo market completely. NSM is another carrier that had a great condo program. They, a lot of their capacity came from Lexington. Lexington has this year withdrawn their capacity for anything over a condo valued over 25 million. And American Capital is a large player, or has been, in the admitted space for condo associations. And AM Best, unfortunately, has just downgraded them to a C- with negative outlook. So there's a lot happening. And you know, I think the mergers and the rate increases are something that, you know, they've attempted to do to stabilize, but there's a lot of carriers that just aren't looking as good, and their balance sheets are not as healthy as they used to be. So yes, are there less viable carriers for the consumer? Absolutely.
And Joe, what is the ratings threshold insurance companies must maintain in order to remain stable during this crisis?
Well, as an insured, you want to look at a couple different things when you're going to partner with an insurance carrier. Number one, you know, the benchmark of financial strength, really the global test is the carrier AM Best rated. AM Best has been around for over 100 years. And they're essentially analogous to like a Moody's for bonds. I mean, it's the same type of a financial rating categorization, and it's global. So if you're working with a non-AM Best rated company, you really need to dig down really far into what those financials are. And Sally had mentioned another financial categorization type company, Demotech in Florida, that assigns a grading rate to a different carrier, but it's not AM Best. And they are admitted in the state of Florida, so there's some backing from the Florida Insurance Guarantee Association. But keep in mind that the carrier becomes financially insolvent, you're only going to ultimately get $200,000 per unit, and that's new. It used to be $100,000 prior to the change in the law. So if you're a large association with a very large insurable value, and you do the math, you might realize that there'd be a significant shortfall there if the carrier would become financially insolvent. So we always look to AM Best, especially in this environment. And even in this environment, we're seeing some AM Best rated carriers be downgraded. And Sally had mentioned American Capital is one. And, you know, the negative implications here with fewer and fewer companies being able to underwrite this coastal condominium risk is that this exposure that they used to write now has to be absorbed and soaked into an already stressed marketplace by other carriers. So it's going to continue to erode capacity. It's going to erode what's available in terms of, you know, deductibles, enhancements, and rates in general. So it's kind of a negative outcome right now in this microclimate that we're in the coastal condominium space relative to the more macro outlook of property in general. But it's compounded even further. But it's important to be aware of what financial categorization the insurance carrier has. And you can look up the policyholder surplus. If it's something that's not AM Best rated, you can certainly look into the details of the surplus that they have. And I had a couple instances recently where a board was evaluating an alternative to an AM Best rated carrier, and we looked at their surpluses. Basically, their cash on hand was less than what it would cost to rebuild the association. So just imagine that you're a fiduciary responsibility as a board member, and somebody actually proposes you an option where they have less money on the books than it would cost to rebuild your building. So a lot of that stuff is going on out there, and it's extremely frightening, and it's a Florida problem.
Yeah. So Steve, what's the cumulative impact of these increases?
I mean, I hate to sound all doom and gloom, but in the short term, the main impact that we're going to see is just the basics of supply and demand, right? We're seeing a lot of carriers exit the state. We're seeing a massive amount of underwriting capacity shrink because, again, for an insurance company to write a condo association or any piece of property, they're basically taking over a transfer of risk. We're paying them a small amount of money. I know that's relative. A lot of board members who've seen the renewals are going to say, what are you talking about, small amount of money in the form of premium these days? And we're transferring it over to the insurance company to assume the full risk of liability in the event of catastrophic events, right? So when there's less underwriting capacity and there's less supply, unless the demand shrinks, prices are going to go higher, right? In addition to all we were talking about with the storms, with the litigation expenses, with the reinsurance side. And again, the reinsurance side is a real big component. I think about a 50% increase is going to be coming down and pushed into the state. But the real challenge is that the demand in Florida is actually increasing. New home builder construction is on the rise, like we haven't seen since prior to 2008. We're seeing a lot of people from the Northeast moving down to Florida. It's all fantastic for us, as an economic boom. But the challenge is we don't have enough underwriting capacity to currently help out the state. And Joe mentioned as well too, we're seeing restricted coverages. We're seeing deductibles that are no longer being able to offer in the 1 or 2%. We're seeing certain coverages being grandfathered in, and other sublimits that used to be offered as an enticement to sale, as an additional benefit, are being removed and restricted from policies. So to answer it in short, what is the cumulative impact is we're going to see a lot less options in terms of financially feasible companies that will insure. And we're ultimately going to see the rise of Citizens as one of the most dominant carriers in Florida, and unfortunately that means Citizens, which should be the place of last resort, is going to become a big, massive player. And that's going to restrict options even further and put more upward rate pressure.
Okay. Well, speaking of Citizens, I read that at a Citizens June Board of Governors meeting, it was reported that due to the decreased reinsurance capacity, many companies have been forced to restructure their portfolios by shutting down all new business in the Tri-Counties, Central Western counties, and more recently, the solo counties of Seminole, Orange, Lake, and Osceola. So Sally, would you say that associations will be paying higher insurance premiums for reduced coverage?
Well, yes, absolutely. I think Joe and Steve also indicated that, but bottom line, carriers have restricted capacity, so they are just becoming more picky. They're saying, they're changing their underwriting guidelines. They may say, okay, we're not gonna write any condos over, like NSM's capacity, over 25 million, or we're not going to take anything older than 25 years, or we're not going to, the roofs have to be, within 15 years, new roofs, that kind of thing. So yeah, there's going to be restricted capacity, which means, and deductibles. We're seeing deductibles and exclusions attached that weren't there before. Some carriers, when they were offering a 2% and a 3% hurricane deductible previously, they're coming in and saying, we'll give you a 5% hurricane deductible, and that's it. And I say, well, can I show the client what the price would be for a 3%? And they're like, no, we're not offering it. So there's things like that I think insureds are going to have to prepare for, which means that, their operating capital, to meet a 5% hurricane deductible is going to look a lot different than a 2 or 3% hurricane deductible. But those are things that, in real life scenarios, that's how it's trickling down for the consumer. So, yes, reduced coverage for higher premiums. Unfortunately, in the near term, that is what we're looking at. And, as agents out there, I know Steve and Joe and I, we're beating the bushes and finding, the best coverage that we can for our clients and showing them variable deductibles if possible. But there is less to choose from currently.
Okay, and you touched on that a little bit, Sally, but Joe, how restrictive will insurance companies be on renewals as well as writing new business?
Well, a lot of it is playing into the fact that so many players are disappearing for this space right now. So obviously with coastal condominium exposure, it's unique, and the less players you have, you're going to have more restrictions in place for the ones that are willing to write this type of risk. And what we're seeing is almost very similar to the parallel when we were coming out of the last hard market, where you're starting to see more subscription-based models in terms of layering. So you're having sort of a primary carrier come in and they would do maybe the first level of insurable value, and then they would split it accordingly. You might have a buffer or an excess layer, or it might just be marketed as one company, but that one company is actually made up of 11 different carriers that each have a proportion of the total insurable value as a percentage. So there's more of an appetite to approach the risk like that versus having one carrier do everything as a total insurable value and take on all of that risk. So some of the things we're seeing, and Sally mentioned the deductibles, is very true, where you might have a risk that's at a 2% or 3%. On the renewal, you get a 5%, and there's no negotiating for reducing that retention. And in some cases, you're seeing the structure of the deductible change, whereas you'd see a lot of calendar year hurricane deductibles, annual aggregate deductibles, which are very favorable and what you want. Now we're seeing a lot of options come out and say, hey, we're going to give you a named storm deductible now, and it's going to be per occurrence. Not as favorable, obviously, because then your percentage deductible applies for any named storm every time a named storm hits. So if you have a year like 2004, you could conceivably, hypothetically, have 4 applications of your deductible in a row. So it's becoming a way less favorable option, but in some cases, it's becoming the only option. So that's what's going on. But we're seeing a lot of layering going on, and that seems to be the way of a lot of the larger insurable value risks are going at this point. And that really, to Steve's point, he mentioned Citizens. No, I don't see them as, you know, a player at this point, but we are getting there. We're going that direction where, you know, obviously the hard market in the past, Citizens was writing a lot of this coastal risk. And we might be looking at that if we're here having the same conversation in a couple of years and we've had 2 serious storm seasons again, and we've taken some major domestic hits. I think that is a reasonable possibility to see Citizens as a pretty standard player in the marketplace within a year or 2, if this is to continue going on at this level.
Okay. So Steve, now that we know the causes of the rate hikes, what can we do about it?
Yeah, and I'll make one
question.
Well, I'll make one quick note on Citizens. I believe we're seeing an increase of about 3,000 to 4,000 new policies in Florida being written on a monthly basis right now. That is a bad sign. So again, something to keep up on. But let me tell you, to answer your question directly, what should we not be doing in order to help with the rate hikes? And that is sitting around waiting for Tallahassee or Washington to put a cape on and come save the day, right? Again, in my opinion, my professional opinion as an agent and an underwriter, they had more fault in putting us in this predicament than they did in trying to solve it. And unfortunately, one of the things I mentioned earlier, the fee multiplier for attorneys, it was actually shot down on the Senate floor last year, despite the fact that all it really was doing was punching the consumers and the insurance companies and pushing the money onto the attorney side. So while I wouldn't say they're completely useless, I would say what we can do as a first line is as community members, as residents of the state, write to our congressmen, write to our commissioners, write to our district leaders, and urge them to take some form of action, because a lot of the people that originally proposed that particular bill are no longer in the Senate. Now, what can we actually do as community members, as board members, as an industry as a whole? Well, we can take a little bit of control as to how we, as a community, market ourselves as a best-in-class risk to insurance companies. Again, it's been mentioned multiple times before, the insurance companies do not have to write us. We have to now sell to them as to why they should take us on. And best-in-class risk management will still always be key, right? And that's loss prevention, loss reduction, making sure that we don't have moral hazards or any kind of potential hazards that can increase the propensity for losses. If we do have losses that we can't control, we want to keep them capped and we want them resolved as quickly as possible, because any potential loss right now that's lower in severity but higher in frequency, like some of these ticky-tacky slip and falls, can really be limiting to us in the market. If you don't already have an action plan as a community, work with your agent, work with whoever you can, even if it's the insurance company, to have inspections done to make sure that there's no potential hazards that are sitting out there. And then lastly, on the financial side, be prepared. I know I think some of the rest of our panel is going to talk about that, but look at your retention schedules, your deductibles. If you're going to increase them in order to save $3,000, $5,000, $10,000 in premium, know that you may have to come out of pocket with $50,000, $150,000, or $250,000 of out-of-pocket expense in the case of a deductible. How are we going to fund those in the event of a storm, right? So, those are all things you can do. Again, to recap it, take control of it, practice safe risk management, write to your congresspeople, and make sure that you're providing some sort of financial responsibility within the association to fund certain things.
Okay. So I'm going to kind of put this out to all three of you, and we can circle around if you have varying answers. But I've heard of boards seeking to put together a captive group of associations, let's say like 15 or so, in order to self-insure and save upwards of 50%. Is this legal? And if so, how does an association go about instituting a captive group? So I don't know, Sally, do you want to start? Do you have anything to bring to that?
I don't think that the Florida Statute 718-111 will allow for captives. Above and beyond that, though, a captive typically operates in a single class of business. So everyone in the captive is a similar class of business. However, they aren't geographically close together. Okay, because captive insurance, the basis of a captive insurance is that everyone shares the risk. So it would be very, very difficult, say, for a group of downtown condo associations to all form a captive together. Then a storm comes through and 3 of the condos have, you know, $5–10 million in damage. Unfortunately, the other condo associations would share in the payment of that risk. So it's not a very, it wouldn't really, as it boils down, be a very attractive thing. I wouldn't think the unit owners, you know, would be all that happy about getting an assessment because the condo down the street had a big claim.
Yeah. Joe, do you have anything to add to that?
Yeah, the self-insurance question has been coming up a lot lately. It always does in a hard market as the rates go up and the premiums go higher. And obviously it's a big line item for associations, so it's a natural question. But you know, to Sally's point, captive self-insurance, it's governed by Florida statute. It's not impossible to do, but you do have to have it approved by the state. Essentially, they'd have to create their own insurance carrier and program, and they would have to fund it. It would be a massive retention that they'd be taking on, and it's untested with respect to individual unit owners and mortgagees and things. Where would they even accept it? We don't know the answer to that. So if you have this program in place, this large self-insurance, and then you go to purchase a unit or try to sell your unit, we just don't know if a lender is going to be comfortable with that. So, and that component of it is something that is an unanswered real legal question, but certainly it's possible, but it's unlikely due to the hoops that you'd have to jump through legally and the statute requires. So we don't typically see this, but a natural question as the rates continue to go up.
Okay. And Steve, anything more?
I can shut this down real quick, right? Because I actually do work with some group captives out of our Texas office. We've got a pretty robust captive environment that we work with. And I'll just tell you, let's say we could do it legally and let's say we could do it feasibly. It doesn't make sense financially to do it unless you're paying in excess of around $150,000 worth of premium on the liability component, not the property side. And the upfront costs in order to fund a captive, without even going into the technicalities of how they work, usually it takes 2 to 3 years for you to recoup that investment in terms of premium savings. So it always comes up whenever the market hardens or when things get restricted, because in the fantasy land, it works out perfect. You can create your own coverages. You can still purchase reinsurance. But there's a very large capital component that's needed in order to start funded. And again, it may take 2 to 3 years until you even see any return on the premium savings because of the amount of money you have to put up front just to fund it.
Okay. So another one I'm going to pose to you all here. What else can we do about the rate hikes? And I'll start with Steve this time. We'll circle back the opposite way.
Yeah, move to Nebraska. I don't, unfortunately, have a good enough answer other than we have to, pardon the hurricane pun, but we have to weather the storm. Joe alluded to this earlier on in the presentation that, these things, they have a cyclical environment, much like any other economic cycle, right? Right now, we're in the midst of a hard market. In my true belief is that we need to just weather the storm and exert whatever we can to help mitigate our own costs and practice our own financial responsibility, because at the end of the day, the free market will win out. We're going to see some carriers from outside of Florida with more of a national presence, when the rates start to get high enough, would like to come in and profit off of that because they can absorb some of the items with the more profitable components of their book. But again, just no different than what Floridians do when a hurricane comes, right? We shelter, we bunker down, and we wait for the storm to pass.
Yeah. Joe, do you have any?
Or move to Nebraska, I don't know.
Oh, yeah. Then you might have tornadoes, I don't know.
Yeah, got to be careful with those too. But I mean, realistically, it boils down to, what are the factors that are taken into consideration when these risks are modeled, right? There's only a couple major models out there that the underwriters are using, and they look at geographic location, which you can't change. If you're on a barrier island, you're on a barrier island. You can't move your association. Or if you're on the coast, you're on the coast. They look at the age of the construction. They look at the type of construction. And then obviously they're very, very laser focused on the age of the roof. And they want to know about opening protections, right? So if there's anything you can do to fortify your buildings or building with respect to building envelope integrity, you're going to be viewed more favorably and you're going to weather the storm better. You're going to be on the lower end of the increase spectrum than your counterparts. If you're an association that has no impact glass, no shutters, old tempered glass that's 30 years old, and your roof hasn't been replaced in 25 years, you're not going to model very well compared to your neighboring building that just did a brand new roof. They tore it down and rebuilt it, and they just retrofitted the whole building with impact windows and doors. So that is one piece that's in your control. The unfortunate part about those pieces is that they're major capital improvement expenditures. So you can't just wave a magic wand as a board and say, well, we're going to replace the roof and everybody's going to get impact glass. You can do it progressively over time, but those things will pay off. Now, it's not going to pay for that project, but it's certainly going to put you in the most favorable light possible in terms of variables underwriting that are in your control.
Okay. And Sally, I'll let you kind of close this out, but I also have a question that came in, so maybe you can add to that. Oops, hold on, somebody else pushed it down there. So somebody asked, with climate change as the ongoing reality for our future, why do you think this storm will pass, and can it be ridden out?
Gosh, I don't think I can tackle climate change. I mean, we have had, again, I think to Steve and Joe's point, the insurance industry is a financial services industry. It is cyclical. I do think there will be more healthy competition that's going to come into Florida. I mean, gosh, this is not just for commercial condos. This is for homeowners as well. My homeowners insurance went up 80% this year. I certainly don't expect for that to continue. And I do believe there will be healthy competition. People will regroup, and come into Florida and balance things out. But I do agree to take control of what you can do, because you need to make sure your agent is presenting you in the best possible light to the marketplace. And they need to be writing a narrative. And if you are on the fence about getting new impact glass, or if you are on the fence about doing that concrete restoration or the new roof, you may want to survey your unit owners and decide, this might be worth it now. Let's look at what we can save on the insurance premium, because they do plug in those elements into their computer modeling, and they can tick a box off. New roof, yes or no, and what the age of it is, and impact glass, opening protection, class A, it's either yes or no. And those things do make a difference on premium. So I think that for associations to look long and hard on all of their maintenance items, anything they can do to make their property model more attractively would be, cause for discussion right now, serious discussion. To answer, the question on climate change, gosh, that's a big topic. I don't know that I'm qualified to speak to that.
Yeah. Shauna, do you mind if I hop in? Because apparently my weathering the storm comment blew up our question chat here.
You started this problem. No,
I'm sorry about that. Let me maybe try to clarify. So when I say weathering the storm, and this is coming from a kid who spent Hurricane Andrew in a closet down in South Florida, I don't mean the physical storm of hurricanes. I mean the metaphysical storm of the economic climate. So I know climate change is a very hot topic. It's a politically charged topic, but I think everyone can agree that we're seeing some wild activity lately in the storm side. Now, I can just tell you this as an underwriter, and from my background on that side, when I say weather the storm, I mean the rate increases. Now, there's only so high rates can increase where we're no longer unprofitable of a risk. And as the market hardens, more entrants will come into the market who are more financially sound than some of the carriers, which will then increase the underwriting capacity and the underwriting supply, which will then generally push things down, even if we still have storms. The insurance industry as a whole is very adaptive. You've got Mass Mutual, one of the oldest and largest insurance companies in the planet, now purchasing Bitcoin, a highly speculative asset, as a way to try to forge their own financial position. The insurance companies understand what's going on. They want to make a profit. They like making profits. They only exist to make a profit in theory, and they will find a way to try to bring down costs as new market entrants come in to capture some of the increases in premium. So that's the storm I mentioned on weathering.
Okay. And we had another one come in to follow up on that, Steve. I guess the question is why, if more disasters keep happening?
Well, again, if more disasters keep happening, we're going to see higher increases of risk. We're going to see higher charges, and we're going to see whether it's a legislative body or the free market on the insurance side come in and find ways to offer competitive pricing. Now, I've been harping on insurance companies about the fact that they're taking these billions of dollars of losses, but let's not be coy here, right? They're some of the most profitable industries on the entire planet. There's a reason why Berkshire Hathaway with Warren Buffett is basically a giant holding company for insurance. On the long enough time scale, insurance companies make massive amounts of profits if they're well balanced, because they take your premium, they reinvest it in the market, whether it's zero interest coupon bonds or less speculative equities, and they make a large amount. The challenge is when the market conditions, and Joe mentioned this, we had like 10, 12 plus years of no storms. So unfortunately, a lot of insurance companies, we had new people come into the state, and they were trying to offer very low premiums as a way to take your money and reinvest it and make more money with little risk on their side. And we saw the market actually push the rates down. We're getting an echo here. We saw the market rates up until maybe 3 or 4 years back. Joe, Sally, maybe you can comment on this. These rates were too low. They were too low to the point where last year, in my opinion, we saw a correction in rate prices, and now we're seeing the increase, right? So again, I'm getting a little long-winded on my soapbox here, but as catastrophia increases and insurance companies profit off of catastrophia, they're going to create solutions that are going to, create a competitive landscape and environment where more players will want to come in to capture the increasing premium, which will increase supply, which will lower costs overall relatively.
Oh, perfect. Well, and Sue, I see your question here as well. I'm going to hold that till the end just so I can pose that to the board of DSCA because it's more of a question for them to answer. But so it looks like we're only going to see rates rising in the coming years. This is pretty much our conclusion here. So let's shift gears and talk about how we can adjust our reserves and budgets in order to offset the high insurance costs. So I'm going to bring Mr. Pete in here, Mr. Pete Rossi. Should we defund reserves in order to raise the funds to pay for the increases?
The short answer is no. And Steve, I'll take our storms over any Nebraska storms anytime, no matter what the cost. The important part about reserves is you're protecting the assets of which you bought into your real estate. And it's important to have those reserves looked at by an engineer and also to review your properties. We consult with any of the projects that your co-ops can get into to let them know how they can schedule upgrades like the storm windows, like the better roofing. There's new code out there reinforcing, allowing insurance companies to be more what's the word I'm looking for, more flexible in their rating. And it allows, because of the code changes that have come down after all these storms, it has improved the quality of life and living in the institutions we live in. I know I live in a Cat 5 house right now, and it got all the modern conveniences of that current code. So in essence, don't cut your most valuable asset, which is all the attractions that you bought the real estate in the first place. And continued defunding reserve is not the answer.
Okay. So could associations add an insurance or emergency line item in their reserves? And if so, would that cover COVID-related expenses as well as insurance rate hikes? I mean, the government is referred to both as a crisis.
We have, it was interesting, this morning's news announced a shortage of all of the stuff that all our home builders are using. And it's become a major problem because of COVID, all of the restrictions, the importing of products. The housing market it may go into a stall because of all the shortcomings, plus the increase in labor costs. People forget about all of the cost of labor, of getting the quality plumbers, getting the quality construction people in place and keeping them there and not letting them get sick, which then they lose that manpower. We also, as a former board member, I can tell you, we looked at higher deductibles and then at the same time looked at insuring those deductibles as a separate line item outside of the reserves. It was something that we reviewed with our accountant, with our legal team and our documents, whether or not that they allow you to do that. But that was just an option that was very attractive to our community, and we took advantage of it. And it became a rainy day fund as well. So it's a dual purpose line item that you can have, and it stops the major hit on an event to what I call the two negative words, special assessment, which no owner wants to hear.
Yeah. So in light of the insurance rate hikes, I've been hearing about associations looking into loans in order to pay for it, as well as for expenses from the pandemic. So Donna, if the association is having difficulty paying for the insurance increases, should they raise dues, apply for a special assessment, or seek a line of credit?
I think Peter just said it. Nobody likes to hear the word increase in dues or special assessment. So a loan is an option for them to borrow to cover their insurance premium cost for any particular year. And I think Peter also said in their budget, the banks look to see if they have a line item for their insurance. And some of them do have a line item for their deductible. So those are two things that we'll look to have. And the banks can offer to associations a line of credit or term loan to pay their insurance premiums when they come due. One of the things that the boards really have to go and look at is what are their governing documents allow them to do for any, say an increase in the dues that they haven't taken into consideration in the budget. Because, and I've had a couple of them already come to me and say, we just got our bill and we have to give, we can't, insurance companies will finance the insurance premiums, or they're coming to the bank and saying, what's your rates and what are your terms? And so they have to have the money within days to pay that premium. So what we've suggested is that they look at their budget item, and I know you're not going to be able to, with everything that's going on, you're not going to be able to predict what the insurance companies are going to do next year. However, the board's got to look at that, and yeah, those are the options that they have, is to borrow. With borrowing, they don't like the word increase in dues or special assessments. However, having a loan to pay for the insurance premium has to be paid back. So how is it going to get paid back over a period of time? Well, they're still going to have to use those two bad words, which are increase or do a special assessment. However, the special assessment or increase is now over a period of time. Instead of a one-time special assessment, we need to collect it now because our premium is due. That doesn't go well or bow well for unit owners in an association. It can be a financial burden on them when you ask for something back quickly or something that's not spread out over time. Lots of people here are on a fixed income. So in doing their due diligence, the board has to take a look at how's it going to impact the unit owners? Are we, in anything they do, is it going to have a financial burden on them, which then has a cyclical effect by having their delinquencies go higher? So they have to look at all of that information to make a determination as to what's the best for them. I think Steve also mentioned earlier about the insurance deductibles. So banks can finance insurance premium loans. Those insurance premium loans are done, typically, we do, it's a line of credit. We'll do a 2-year line of credit, and the association for this particular year can borrow the money to pay their insurance premium that's due. They'll get charged interest only, but between 11 or 12 months, they have to have paid that all back. So what does that mean? They either have to increase their dues for 11 to 12 months, and that's a big increase if you've got a lot of money, depending on your size, Or it's a special assessment that, again, you allow the unit owners to pay over 11 or 12 months. You have it paid off, the money's now available for you to have for the next year when you get your insurance premium. And you're hoping that while you may have this line of credit, when they look at their reserves, or when they look at their budgets, they know how much their insurance was this year. They might bump it up so that they don't have to use a line next year. So it's really a balancing act of the budget and what they want to do and how it's going to affect the unit owner. So that's the typical financing we see for insurance premium financing. Steve mentioned the deductibles. There are some associations, and Peter said it, they may have a line item in there for their insurance deductible. A line item to cover the premium in a year, a line item in case they need the deductibles. Banks will also offer an emergency line of credit to associations specifically to cover the deductible that they might have in an emergency. So they have the funds available to match the deductible so they can get the project started while they're waiting for their insurance to cover money to come in. They're allowed to have that money, and within 90 days they have to come back and say, okay, we're going to pay it off with an increase in dues, or we're going to special assess. But that's the second type of financing that's available. So
we're getting feedback now for some reason.
We are.
After considering their options, Donna, can you walk us through this checklist to guide us through the pros and cons of getting an association loan? And you probably touched on some of this already.
I've already talked about, I've already talked about the cons. The cons are you got to go to the unit owners and collect more money to pay it back. Or but the pros are, as we said, it's about taking the money and spreading it over a period of time, whether it's an insurance premium loan, insurance deductible loan, or a loan for any specific other project. People come and borrow. The question is, we absolutely want to see you reserve your money for your future projects. But in some cases, there's always like two rules of thumb. Some say, don't borrow. You need to reserve. And when you have the money in the reserves, then you do the projects. However, with the cost of things going up, and right now cost of things are down, some associations are saying, you know what, let's get the project started. We can use some of our reserves and finance the rest. They're not waiting until they have the money. Sometimes they can't wait. So there's two thoughts out there. Some say, don't ever borrow, you always reserve first. And some say, well, we'll borrow now and we can continue to save our reserves for the future, because we'll lend 100% of a project. You don't need to use your reserves. That's, again, a judgment of the boards making a decision and doing their due diligence and what their governing documents have to say, as well as looking at their reserve studies and speaking to Peter or anyone else as to just specifically what is their requirements going to be. So to answer, long story, now we'll get back to your question. The first thing that they want to do in an application process, as it says, is you want to speak to your attorney. And while you're starting this, you speak to your attorney, you need to find out, ask them what are the governing documents allow them to do. For instance, can the association borrow? Does the board have the right to borrow the money, to vote on doing the loan, or does it have to go to a unit owner vote? Which one do you have to do? The second thing that they have to ask their attorney is, how can they repay it? Will their governing documents allow them to pay it one way or not another way? Or who can vote on the repayment, or how the repayment of the loan is going to be? Again, does the board have the authority to do it? Or is it the unit owner? So you have to go to vote, or they get to vote as to what you're going to do. Either way, if the board's got the responsibility, they have to always be in front of their unit owners and keeping them abreast of everything that's going on. So that would be the very first step that they need to determine, is what the governing documents are going to allow them to do, and who's got the authority to do what. I know this says next is to consult your banking and your reserve specialist. I think Peter's mentioned some things already. They definitely have to weigh their pros and cons. They cannot, they can't use their reserve money unless it's specifically for a project. They can't use that to pay back an insurance premium loan. So there's a lot of conversation that has to go on between speaking to a bank and or speaking to their reserve specialist to see what's the best practice for them. Speaking to the bank, we're going to partner with you and say, let's look at what your insurance premium is. This is a particular product. There's more partnerships going on as you're starting to do a project. You want to do a roof or paving or windows. you're going, same steps apply for this as it does for the insurance premium or insurance deductibles. So that's where your major start is, with the attorney. And then you want to talk about this thing with a bank. If you have a bank that you're working with right away, you can brainstorm with them. So that works with your, your association-friendly bank. Right now, there are banks out there that all love to do loans because there's just no risk in them. There really are no risk because you get a loan. The loan is to the association. However, their income flow is from the unit owners. So as long as their income is coming in and the unit owners aren't in default, and even if they are, the association has a collection policy in place, where if you have somebody who's not paying their dues, follow your collection policy, a new owner is going to come in, they can pay the dues. So banks are saying, oh, these deals are really good. We have a risk. And they do have a risk at the beginning because, and I'll talk about the collateral when we get to that last slide about the collateral, because these loans aren't secured by anything that the association has. Nobody's guaranteeing it, nobody's liens. So that's each association is different. They really need to talk about it with the board, with the reserves, with the banks to come up with how they might want to pay it. The next thing is to talk about, well, actually, when I talk about the user-friendly, we're going to go into the documents, but in underwriting a loan, the standard for underwriting is pretty basic. The associations, when we look at them, we look at the number of units, we look to see if there's any delinquencies, we look to see how many units are owner-occupied, investors, we want to see what their delinquency rate is, we look at your reserves, we look at your balance sheets, we look to make sure you've not, even if you're losing money, we know that you have it in your, it's just a whole complete analysis of the financials. But really the standard is delinquencies, past due delinquencies, how much of an increase is it going to be? How is it going to really impact the unit owners? That's our first question, is because if it's too much of an increase on those unit owners, then your delinquencies are going to go up. So that's the basic standards that we use for underwriting. So it's pretty basic down to, it's not a lot of stuff to it. The next step is documentation requirements. We try to keep it as simple as possible. It's like a one-page application, fills us in about all your information. There's an application. We get the current budget. We want to get a current year-to-date analysis, budget to a current year-to-date financial compared to budget. We get a delinquency report. We get 3 years of financials, maybe 3 years of tax returns, get the governing documents. And then if you're doing a contract for windows or whatnot, we want to review the contract. This being insurance premium financing, we want to look at what your insurance premium bill is. If it's your deductible finances that you want to do an emergency line of credit, we want to look at what your deductible is so that we can match that and make sure that's all in place. Then the next piece and all that gets done, you get an approval. Then we have a commitment letter. And from the commitment letter, you go to closing loan documents. Now here, there's different theories and different things happen. The loan documents can be prepared by attorneys, or they can be internally bank prepared documents. Either one works, and I know there's some question about, well, internally prepared documents that a bank use are pretty standard. They don't always be specific to condominiums. There's ways to work around that. Please note that if you do an attorney prepared closing, you, the association, will have to pay all of the closing costs for both the association's attorney and the bank's attorney. So that's something to consider when and if you, depending on the closing that you have. And then there's an opinion letter. That's an opinion letter from the attorney that's telling you that, or telling the bank that the closing documents are right, they've done within the state statutes, and you can close the loan. They've reviewed everything. Sometimes an opinion letter is required, and sometimes it's not. It's not always something that they have to do. And then everybody reviews the closing documents, and then you close the loan. You either close the loan in the attorney's office, in the management office, closing it on site, because again, you want to find a bank that's going to partner with you and work with you. So if you have to close a loan and they can't get to where else, you go to them and to their clubhouse or wherever to get them to sign the documents. And the other type of closing that we've seen over COVID more so this last year is doing DocuSign documents for loans. That way nobody's got to come out, and the association can continue to do business because they can still do it from the comfort of their home or their safety of their home. So that is the documents that required. I know that I kind of quickly said all that. There is something on here that talks about no release. So what that's addressing and what that question came about is if you're doing a loan and it's being supported by a special assessment. In some cases, the special assessment, the board will allow unit owners to pay their portion up front. Anyone who didn't pay up front will participate in the loan. So their special assessment, they'll collect every month and they'll pay it towards the loan payment. Well, some people who paid their special assessment up front are asking that they can be released from anything future because they paid it up front. And the understanding has to be that the answer from the bank is going to be no, because our loan isn't to you, the unit owner, our loan is to the association. And that special assessment is coming in and they've had your money. But really the reason why is that it's just like dues. If you have somebody who's past due on your collection and they're delinquent on their dues, well, your association has the right to assess everybody because of, in order to have your budget work. It's the same thing with this. If the association were to default on the loan, you may have done your special assessment up front, but the bank wants to be able to step in, work with the association to make sure all their bills are getting paid, as well as maybe they got to increase the dues or do a special assessment to make sure everything gets paid, including the loan, even though you put in a special assessment prepaid.
Okay. And I had somebody ask.
I know, it's a lot of material.
Yes. I had somebody ask about what the current interest rate is.
The interest rates are going to be based on the number of years the project or the loan is going to be. So I can't specifically give you an interest rate. I can tell you that I can't even do that. I haven't looked at the rates today, but they're relatively low compared to what they were. I know, so I'd have to do a quick look, but they're relatively low. They're in the 3s and 4s. Between a 5 and a 10 year, they're between 3 point something and 4%. So they're pretty low. And the rates can be locked in for the term of the loan.
Okay, perfect. So you spoke briefly, you said collateral earlier. So what type of collateral will the bank require on an association loan?
Okay, well, because this is an association, and I mean, many, many years ago, about 20 years ago or so, banks weren't interested in this kind of loan because they were used to tangible assets. I used to say, as a commercial lender, I want to go out and kick the tires. I want to go out and feel the building. Well, with association financing, you can't do that because you can't take a lien on anybody's homes. You can't take a lien on a clubhouse or any of the common area elements. So what is your collateral? The only collateral you can take is a security interest in future income of the association, the cash. So you do that, the banks take that as collateral, and we protect our lien by filing a UCC with the state records. And it specifically is just on the receivables of the association, which will include, your current assessments that you're paying, special assessments as well, any other income that you might derive from other sources. And understanding that if you have reserves and stuff, we can't touch those. But if you go in default, this is our collateral, and we can work with the association under the statutes and the judges to say, okay, we can step in and do what we have to do. But our collateral is just basically a UCC financing with the state on future income of the association.
Okay, perfect. Well, I think we have a few minutes. I don't know if Jamie or Patrick are on, but we have until 5:30. Is that correct?
That's correct.
Okay, so we have a few minutes that we can take some questions. If anybody's got some questions that they want to put into the chat for me, we can go ahead and take those. For anybody, Jamie, I don't know if you want to answer this or if anybody can answer this who's on from the DSA board, but Sue had asked if in relation to that whole weathering the storm comment, is the DSCA involved with lobbying at the state level to deal with the increase in litigation?
Yeah, I saw that question. Thanks, Shauna. No, the answer to your question, Sue, is the DSA does not lobby at the state level.
Okay. Let's see. Anyone else? I don't have anything coming through. Last call on questions, guys. Anybody have anything?
Cool.
All right, well, we don't have any further questions. I'd like to thank our panelists today for this great information. You guys were all fantastic and shared a lot of great info for us. If anyone on here has any additional questions, or you think of some questions after we close out this evening, please feel free to contact any of our panelists directly. I'd like to thank the DSCA for hosting this presentation and remind our attendees that these programs would not be possible without the support of the DSCA Platinum Associate members. And at this time, I'm going to turn it back over to Jamie Still, DSCA board member for Associate Members and Events.
Okay, yeah, just like Shauna said, thank you everyone for attending our event today. And thank you so much, Shauna, for moderating our event. I wanted to thank all of our amazing panelists for the great information today. And now what we're gonna do from here is we're gonna take a look at the attendees who have opted in for a prize and who stayed on for the program. And once we have that list, our Platinum Associate members will contact the winners of the giveaway. So I would actually now like to take some time to hear from our Platinum members who support the efforts of the DSCA and who we very much appreciate. I think the first one we have, and now I'm just going to go through the list of the people I see that were here, and if I've forgotten anybody at the end, please speak up. Atlas Insurance. Anybody from Atlas? I thought we did. All right. How about Brown and Brown? Nope. Castle Group, Shauna.
Well, if you haven't heard enough of me this evening or this afternoon, so again, I'm Shauna Fleischbein with Castle Group Property Management. We specialize in full-time on-site management of both condominiums and large-scale HOAs. So if you guys have any association management needs, please feel free to reach out to me. We'd love to help you all out.
Thanks, Shauna. How about CBiz? Is CBiz here?
Yep, I'm here, and I'm sure you guys have heard me speak enough today, so I'll just make it short and sweet. We are a full service risk management broker. On the insurance side, we do a lot of things outside of just placing the policy. My colleague, Matt Mercier, is one of my partners, also based over in the downtown Sarasota area. And if you guys need any help, you want to have anyone take a second look at your policies, or you're looking in anything outside of traditional insurance when it comes to risk management, drone site surveys, etc., please reach out to us. We'd be happy to help out. Even just have a conversation about potentially moving to Nebraska. It can get you a great travel agent too.
Thank you. Forge Engineering.
I don't know, Steve. You
Never been to Nebraska. I don't know. I got a feeling there's no hurricanes there.
I came from the Midwest, so I'm familiar with what goes on up there. Forge Engineering is going to be celebrating its 25th anniversary coming up in September. We've been serving Florida for those wonderful years and helping communities like yours develop plans to protect the valuables and the infrastructure of the communities which you bought into. There are so many options that engineers can provide as long as you get licensed engineer to do your evaluations. We work with you and your budgets. We try to plan out a particular project so that it meets the financial requirements. We try to stay away from special assessments and additional costs. We try to work within the reserve studies itself and advising you on what items should be further financed or upgraded in those low times when we don't have storms. But we consult for free. So please call us whenever you're getting into a project so we can decide whether or not you need an engineer. And if you do, then we'll come in and talk to the board as well as your owners, because we believe in education and communication. And we appreciate being here today. And for those who stay around, we have a Bonefish Grill gift card to give away.
Thank you, Peter. Gulf Shore Insurance.
Thanks, Jamie. Joe Thompson with Gulf Shore. For those of you that aren't familiar, we've been around by name for over 50 years. We were founded down in Naples, and we've grown considerably over the years. I have an office in Sarasota, Fort Myers, Marco Island, Fort Lauderdale regionally, but we're also part of a much larger organization called Acrisure, which is one of the largest global brokers in the world. So that's been a great partnership for us. However, we're still Gulf Shore Insurance. We do business as that firm. I specialize with coastal condominium associations, and I can't stress enough to board members how important insurance is with regard to your fiduciary responsibility, especially now in these times, and understanding what you're purchasing and what you're covered for and what you're not covered for is really the most critical component of insurance. And it's the most important thing you'll ever purchase. So to have an advocate, to have an advisor as opposed to a commodity peddler of insurance is very much important in this marketplace, because so many agents now are just reactionary based and they're not proactive. So that's something that we really pride ourselves on. So certainly would look forward to the opportunity to speak to anybody in greater detail about that. And thanks again for having us part of this webinar today.
Of course, thank you. McGriff Insurance Services.
Hi, thank you, Jamie. Sally Voorhees here, McGriff Insurance. I appreciate being part of the panel today. Like I said, I specialize in condominium association insurance. I've lived in Sarasota for 35 years. So I know it well, even though we've got a lot of new buildings popping up everywhere. The landscape is changing. We at McGriff, I have a team that I work with. We have a dedicated claims division. We also have a risk services group. So they work with me. They'll come out and they'll do a risk survey of your condo, and we can see if we can be of any assistance. So let us know. And thanks again for allowing us to be part of this.
Thank you. I thought I saw Patricia Stabler from Stabler Appraisal.
I'm here.
Yay, there you are.
Good to see you all. Good afternoon. That was a very interesting presentation. Stabler Appraisal and Consulting, we provide reserve studies and insurance appraisals, and we're pretty busy. A lot of associations are already starting to get everything together for the annual update. So we're already starting with the budget season very early for this year when compared to the past years. So everyone has the ducks in a row, which I think is very good. We're also doing a lot of FEMA work right now. We provide 50% FEMA rule appraisal for properties which are built in flood zones and require addition, renovation, substantial improvement, substantial damage. And for that purpose, we provide 50% FEMA appraisals. In the last community magazine, I wrote an article about construction cost increases. You might want to take a look at it. If you didn't get the magazine, you can go to the CII website and see the digital version. There's a lot of issues going on in the construction industry right now. And on top of your insurance rate increases, you will have to deal with construction increases, specifically lumber, which increased from $225 per 1,000-foot board to over $1,000 per 1,000-foot board over the past 1.5 years. So that is something you shouldn't leave out of your mind when you start calculating and looking into your insurance appraisal updates and also reserve studies. That's it for now. Thanks.
All right, thank you, Patricia. And I think Michelle from Tannenbaum Scroll is here. Is Michelle here?
Well, she is, but I'm subbing for her.
Okay. Well, go ahead. Welcome.
This is Alan Tannenbaum. I'm with Tannenbaum Scroll, Lamole, and Kleinberg. We are construction lawyers working primarily within the community association field. We do turnover claims, construction defects, but we also represent owners on major repair projects. I can tell folks by experience that there's a lot of contractors out there peddling their wares, giving owners contracts that are not consumer friendly. One example, there's a roofing company, I'll say it out loud, Total Home Roofing. They are marketing their roofs all over Southwest Florida. It's a company that's actually out of Daytona Beach. And what they are is a roofing marketing company. They have people sign contracts that are assignable. They sell you on a roofing job by one of their salespeople. And then who shows up in your job could be somebody totally different. So one of the things we do is that we review proposed contracts, make them more consumer friendly for associations, and likely will chase away some contractors in the process that you really even should not even be considering. Hopefully I won't get sued for this conversation.
All right, thank you very much. And I think that's all of the platinum members that I saw that were logged in. Is that correct, or am I missing anybody? Speak up now. Okay, if there aren't any more, then once again, I just wanted to thank everybody who came to our event today, and hopefully you guys learned something that you can use.
Thanks, Jamie.
Thanks.
Bye-bye.
Thank you, everyone.